kick off, and Carol will jump in. She's having troubles with her Zoom. The Zoom gremlins are out this morning. Well, welcome to the Daily Energy Markets podcast. It is the 21st of March. I think that makes it some kind of spring equinox when the light does change, or the spirits, the druids, gather in dark corners on the island of Ireland and throw a spell on the world like they did against England the other day. But nonetheless, that's a whole different other story. Brent crude oil is trading this morning down a few cents. It sort of seems to have discovered a new sticky little spot at $73 and change, $10 or so below the sticky little range it was in for most of the first quarter in the low 80s. Now we seem to be exploring the sticky little space of low 70s as the world dances with its banking crisis. You wonder if this morning in Moscow that President Xi and President Putin are having a little bit of a dance of celebration, or all of these things disconnected. The Russia invades Ukraine, triggers accelerated inflation in the world, sets central banks in an upward motion on Fed rates and hikes that put great stress on international banks that then fail. Are all of these things completely disconnected? But nonetheless, seems to me the dominoes continue to fall from one source, and that's Russia's invasion into Ukraine. But Paul Hicken, editor-in-chief of Petroleum Economist, first time I think we've had a chance to talk since you taken on this position, so congratulations on that. Where do you think we're seeing oil markets at the moment? Are we going to discover a new sticky range of 70 to 75 on Brent, or is this just a temporary moment until the banks and the central banks get their act in order and we'll go back to the 80s in no short order? Your thoughts on the market outlook?
Yeah, thanks, Sean. Well, I think, there is a bit of a pause right now. I think you seeing the market trying to find a bit of a bottom, and it's trying to factor in risk at the moment. What's happening is you're trying to look at what it's trying to contain that risk and factor in the risk. And it's really about how much that risk translates into what does the banking crisis mean for actually talk about oil prices, what does it mean for demand, or what does it mean for the recession? And yes, there is potential economic weakness, and it does put the Federal Reserve in a bit of a bind in terms of, because partly what's triggered this is the speed of the way the Fed has raised rates. It's put pressure on certain weaknesses in the banking system, and now it has a bit of a choice between continuing raising those rates to fight for inflation, or risk further wobbles to stability. And without further policy measures, it's a question of how much this is self-contained, this crisis. I mean, but a lot of people talk about harking back to 2008. It's very different to then, where we had the subprime crisis, a lot of bad loans. Banks were cleaned up in much better state, you would argue, although no one really quite knows what's under the bonnet sometimes. But you'd argue it is in a lot better state. So you'd think it would be self-contained. And if that is the case, at some point, prices are going to start returning, creeping up higher. Maybe not straight away, but if you look at where people were talking about oil market balances, June, when sort of if China demand continues picking up, and the sort of the fallout from on the OECD side does start to find some bit of a bottom, then you're going to start seeing that it work itself out between June onwards. And that's probably why there's a lot of talk about people holding fire, OPEC plus holding fire, everyone's sort of seeing how things pan out with this crisis right now. And
wait and see. Probably it would be a bit like trying to catch a falling knife if OPEC plus was to move right now. Dr. Carol Nachley, CEO of Crystal Energy. Carol, of the sort of three big ones today, the Fed meeting in the US, the banking crisis, I don't know where exactly it is today, but it was certainly in Switzerland over the weekend, and the meeting of Russia and China in Moscow. What is grabbing your most attention, do you think, to have impact for the direction of markets going forward?
Good morning, Sean. Good morning, everyone. Well, look, at the beginning of the show, you listed all the factors that are driving oil markets, and it's been like that all along. So for this year, even last year, when you look at the forecast for this year, there were three factors that were listed constantly and across various publications. That is the macroeconomic outlook, the global economies, the fear of a recession, where and when and for how long. And there is a China's rebound in demand post-COVID zero COVID policies. And there was a war in Ukraine. So these were the three forces that were driving various forecasts, and they continue to drive them today because the banking crisis feeds into the global economic outlook. So I wonder what we saw at the beginning of this year, the more optimistic, I would say, economic forecasts that were published, for example, by the IMF and other forecasting agencies and international organizations, whether they will be revised now downwards because of the banking crisis. And that means that the fear of recession that kind of faded at the beginning of the year is now coming back with vengeance. Chinese demand is growing, but is it at the same speed that people expected, the wow factor that people expected? I'm not quite sure we are there yet. And so far, it's proven to be not strong enough to compensate for the fear in the economic outlook. And then the third factor, the war in Ukraine, it's still ongoing. And really, nobody knows how the world will look like after the war in Ukraine. But the Chinese president's visit to Russia tells me either it's not going to end anytime soon and there could be some escalation, or there could be a detente, as we saw between the deal with the deal between Saudi Arabia and Iran, although China has a different leverage when it comes to Russia. So for today,
it's hard to identify that the Chinese have any incentive to stop this war. I don't see where they would have any. They're winning all the way round at the moment. Why would they stop?
Winning, yes, but for the long term, I'm not questioning. At the end, the Chinese, they don't want to be siding with a losing party, right? That will have bad impact on their, outlook for the future or reputation or the stance of China. I would say that maybe there could be a chance that they are trying to broker a deal. I know it's a very low probability compared to what you said, Sean. Of course, there is a greater benefit maybe to see the situation ongoing and to show that China is a big influencer on the global scene, which it is. But there could also be a potential room for, brokering a deal. After all, China does not want to be siding with a losing party if Russia is seen as a losing party.
Indeed, it is a question of sorts. Mark Howson, head of Asia at Wellington Analytics. Mark, welcome to the table for the first time. I think you're joining us on the Daily Energy Markets podcast. It strikes me, Mark, that from the point of view of China reopening, China recovery, it may be not reflected that the oil price is the right place to look at sort of a granular insight as to whether it is or it isn't back. And maybe LNG is more an accurate place. And in that corner, we're not seeing the China reopening have much impact on the LNG price and demand, if you like. What's your analysis there in terms of what that tells us about China reopening?
Well, morning, Sean, and thanks so much for having me on. To us, it's actually very interesting looking at the LNG market at the moment, because certainly in Asia, prices are still above $13 per MMBTU. Now, obviously, that's a lot lower than last year, because obviously there's a war just started in Europe last year. But aside from last year, we're actually at very high LNG prices, because remember, we're now pricing into the shoulder months, which are particularly April, but also part of May as well. So if you take last year aside, we're actually still in a pretty tight market for LNG in Asia. And obviously, China's been a large contributor to that this year. If you look at the February numbers in terms of China's LNG demand, they have actually gone up significantly, 8%. And
over what period?
Versus last year.
Okay, versus last year.
Yeah,
not versus January.
No, exactly. 8% year on year. But of course, what is suppressing prices is what's going on in Europe. As you all well know, there was a particularly mild winter in Europe, and European gas demand fell. In fact, industrial gas demand fell by 26%. So that rather savage decrease in European gas demand, combined with the mild winter, plus the fact that the European players were particularly proactive last year before the fourth quarter in terms of building their LNG inventory levels through active procurement, but also setting up new regas facilities towards the end of the year, particularly in Germany. They had 2 FSRUs up and running within 6 months of them being proposed. So I guess all that proactivity on Europe's part has kind of meant that their gas inventory levels are actually now above their typical 5-year averages. So that bearish factor, in a way, is being mitigated by this return of China into LNG procurement.
And I didn't get a sort of a sense there from that this tells us that China's reopening has a lot of momentum to it right now. There's been a lot of talk that this is the year of 2 halves, that China's soaring demand will come in H2. Is that overcooked, Mark, or do you think you'll see that in the LNG markets?
We certainly expect Chinese LNG demand to increase this year. Last year was a very extraordinary year because for the first time in 2 decades, Chinese gas demand went down and also their LNG demand went down by almost 20%. So we certainly expect Chinese LNG imports to go up this year due to the fact that prices are lower, so they're more likely to have a lot more spot procurement than they had before. They've actually also got up to 6 regas terminals kind of starting up this year and contracted volumes ramping up as well. We don't think domestic production there is going to be what it was last year in terms of growth as well. So we do think Chinese demand will come back this year, probably not to the levels of the ferocious growth we saw prior to 2022, because the Chinese economy is obviously growing slower than it did in those previous years, partly due to the lingering effects of these lockdowns.
Paul, thinking of another actor who maybe isn't too keen to see the Ukraine war resolved, maybe US and China have a common interest there, as they both seem to be winning, with US oil exports to Europe hitting a record in March on steep discounts. I'm wondering, from your analysis, Paul, what is the impact with oil now trading at below 70 on WTI, a number in which the US president has said he's going to refill SPR, and getting close to the zone in which this price cap is impacted? Where do you think the synergy of those issues collide at these prices?
Well, I think you've got to remember, one, that oil prices are still pretty high at $70 a barrel. If we're staying around this range, they're still pretty high. And secondly, remember that freight rates are remaining high. We've had this upending of crude flows. It's had this real knock-on effect on longer tanker journeys, reduced fleet. And that is also contributing to the costs that going into everything. And I think it's pretty important to look at it from the other side, in the sense that actually the lower oil prices could start, if they maintain it towards $70 a barrel, could start feeding to lower inflation, and actually could be supportive for recovery. I think no one's really talked about that in that sense. From the other side is that the lower prices, they stay. They could help the US and others get out of this little bit of a catch-22. So we could be down
and avoid recession, perhaps, or certainly put downward pressure on inflation.
Yeah, it's the fact is, I mean, where did the whole crisis come from? It was almost born of COVID and the fiscal stimulus that came from that. It pumped up prices. No one really reacted last year when we had the boom times. It was exacerbated by the Russian crisis. Commodity indexes hit record highs, and no one really reacted until we really went to demand destruction mode. And this is all playing out now. So actually, lower prices could actually be quite beneficial if we have any reduced flows. Could take ease off the tanker market as well. So there are sort of glimmers of positivity to have from all these crises, to be honest.
Carol, I wanted to get your sort of singular focus on the Fed meeting this week and what your outlook for their decision would be. Clearly, pre the collapse of the bank in Silicon Valley and the dominoes that have fallen since, there was very robust analysis and expectation and signaling from the Fed that they were definitely on 25 points, maybe a 50 point again, given that all the inflation data and the employment data was indicating still very hot and they may need to go even back to a 50 basis points. Now we've had all the bank stuff, and the sort of the analysis is no, they have to pause. Where do you sit on what the bank stuff means, the bankruptcies, and the Fed challenge with inflation and the decision they need to meet this week?
I mean, definitely for the central bank in the US, the Fed, they are not in an enviable position. But to sum up the way I see the situation today, I'd like to quote, was it Christine Lagarde last week, who said there is no trade-off between prices and financial stability. And that by itself conveys a kind of sentiment that we have with the Federal Reserve. We don't really have a full-blown financial crisis, and inflation is still high. It is easing, but it's still high. And we are still far from the targets that the central banks would like to see for the inflation rate. As such, while there is a kind of some optimism, we see that a bit in the stock market today, that because of the banking crisis, we might see a pause in the hiking of interest rate. I doubt we're going to see a U-turn in the policy of central bank. We may be seeing an easier rate hike, but the rate hike is going to continue because, first of all, we don't know how big this banking crisis is going to be. It's still too early. It might become, a full-blown financial crisis, but we are far from being at that level yet. But there is a bigger problem for the central bank, that is the price, the high inflation rate, price level. And that's why I like this idea of the no trade-off between price and financial stability, which confirms that probably banks will stick to their increase, but maybe a softer stand. And they told us that. They said they were going to follow the market and see what's happening in the market, and they will adjust their policy. But I doubt there will be a U-turn or abandonment of their policy because of this short-term developments. So we'll have to wait and see.
Mark, looking at the China piece, the reopening, and of course, last year, China was more or less out of the LNG market. And so the rest of Asia could breathe a little bit as Europe sucked in and created a very high, although a very elevated price. But nonetheless, if China had been in the market last year, it could have been, blow your head off prices for the rest of Asia. I'm wondering, where is the rest of Asia now? All quite dependent also on LNG, and very vulnerable countries, Pakistan, Bangladesh, etc., and the mature economies of Japan and Korea. Where are they vis-a-vis this softer LNG price, but still, a pause, if you like, in the seasons of when demand will surge again?
When we speak to players in the market here at the moment, Sean, there are really two markets in Asia that particularly suppliers are very focused on at the moment, and think their LNG demand is just going to rise and rise even throughout the next few years with this very tight market. One of them is the world's 5th largest LNG importer in North Asia, and that's Taiwan. Taiwan have got a commitment to phase out all their nuclear plants by 2025, and obviously ambitious decarbonization objectives as well. They literally a couple of weeks ago shut down another plant, and they've been extremely active in the LNG spot market. So we certainly expect Taiwanese LNG demand to grow aggressively. And as I say, that's a major market. The other important one, and I mean, we were literally in Bangkok 2 weeks ago, is Thailand. Thailand is Southeast Asia's largest LNG importer by far. They only started importing in 2011, but their LNG demand already exceeded 8 million tons last year. And if you just look at the kind of supply-demand balance there, their domestic production sadly is going down rather steadily, and then they don't have many options. They pipe gas in from Myanmar, but due to the challenges with that, they really have to aggressively come to the LNG spot market year after year. They've signed a load of oil-linked contracts from countries like Qatar, but others as well. But that's not enough. They're having to increasingly supplement that from the spot market. And then, like you say, there's another tranche of importers, the Bangladeshis, the Pakistans, the Indias that are very price sensitive. So if LNG prices get below that $10 mark, you could start to see them coming back into the market.
But unfortunately, they've no storage capacity, do they, to take advantage of lower prices?
Yeah, that's one of the challenges. What is particularly useful for India is obviously they can boost their coal usage. So it's really LNG in that country competing with coal because they've now built out their infrastructure whereby they can bring in LNG if the price is right. And even if you look at a Pakistan, they are sadly, going down the route of increasing coal usage as well in light of these very high LNG prices. So I guess it depends where the spot price settles as to what their demand's going to look like.
Let's just go to the survey question this morning, which is sort of where I started off my little conversation. All the global attention on China's visit to Russia has been about resolving the Ukraine crisis, the so-called China peace plan. But what will be Xi's direct message to Putin? 1, time to end the war. 2, green light to keep going. And neither, continue this sort of Chinese ambiguity. It seems to me that this peace plan is simply a fig leaf in order to give China some perception of continuing to be neutral in the eyes of important trade partners in China, but really a country that has had no conversation with Zelensky yet, being a peacemaker, does seem a bit rich. Paul, we've had some significant developments in Europe this week. I'm not sure where it translates into impacting prices, but perhaps you can give us your outlook for that. Strikes in China, or not China, it's not China yet anyway, France. Strikes in France that are significant and growing. And now we've had an announcement that there will be a strike in the North Sea, which could see a lot of rigs closing there. Your thoughts on where this is going and at what point does it have a bearing for the oil markets? You're on mute, Paul. There you go.
Yeah, sorry about that. Well, there is certainly having an impact for strikes in France on both LNG and oil. It certainly will have a small impact. And I think if you think about the wider issue, this really creates back to the energy trilemma, affordability, and I think everyone's feeling it. We're at a position of high oil prices. How is that translating into on the ground, and what the impact of strikes is actually to create further, we could actually end up hurting prices again. So I think that we're in sort of a bit of a bind. I mean,
on that point, when you take France in particular, refineries shut in at a time in which the European market has closed its access to its main supplier of products out of Russia, and yet there's no duress in the market. Why is that?
Well, I think the main reason is, the main duress, there's no real duress because I think the market's been fixated on other aspects, to be honest. And I think the strike is probably going to be seen, it will be resolved in a few weeks. People sort of shrug their shoulders often at strikes in France. It seems it's quite a normal procedure, even with the strikes around the North Sea. It's been a bit of a regular occurrence of more of late, and I think it gets resolved generally quite quickly. And given the wider issues in the market, I think the market is really shrugging its shoulders at that. It's a bit, like we said, how the market has been so fixated on Russia and China for so long, that when the banking crisis came on, it sort of threw the market out of its range. And I think it's where the market is focusing its energies now, and that's really on the Fed right now, and whether you fight the Fed.
Don't fight the Fed, they say. But what about the other Fed, Carol? The oil Fed chairman, Prince Abdulaziz bin Salman, and OPEC Plus. And prices at these levels you would think start to get their attention a little bit, although they've sort of indicated they don't target price, they target to balance the market. But nonetheless, we're getting into territory now on an average at Brent at these prices would see the Saudi budget move towards deficit. I'm wondering, do you expect OPEC Plus to start ringing the phones?
It's interesting with OPEC Plus because, again, over the last few weeks before this banking crisis or the difficulties that some banks faced recently, before that happened, we were hearing more optimistic views coming out of OPEC Plus about the strength in Chinese demand, about the positive outlook for the rest of the year. But one person stood out in all this, that is the Saudi energy minister, because he kept on reminding everyone when he was asked about Chinese demand, he said, "I believe it when I see it." So there was this kind of cautious optimism, if you want, within the organization. And of course, with the prices today, they will be attracting their attention. What else? But does this mean they are going to rush and announce production cut? Maybe, we don't really know what they will do. But I would say if they do that, this will reflect that there is a sense of panic, that the market is going down. So there would be more caution, I would say, to wait and to stay course at the moment and then see how the situation will unravel in the coming weeks rather than rush and then announce any production cuts, which may prove premature. So it's too early, but definitely they are following what's happening in the market because prices are all is their bread and butter, right?
And there's certainly, you would think, getting into nervous territory that nobody could have foreseen only 10 days ago with the bank collapses that have come. Mark, I wanted to get you started out the conversation saying that even for this time of year, that LNG prices are quite elevated given we're into the shoulder months, and that obviously towards the next winter demand and everything could come back into a stress point. And the main solution for Europe this year or over this energy crisis has been LNG from the United States. And I'm wondering, from your outlook, where is the US LNG industry as the continued savior of Europe's mid to longer term solutions with next winter having previously been identified as a big challenge, maybe not as big now, but where do you think the US goes forward as the savior for the European gas market?
Well, you're exactly right, Sean. And again, if you look, I'm sure you've noticed in the news today, today Asia time, yesterday US time, Sempra's Port Arthur LNG, where a huge project, actually reached final investment decision on the US Gulf Coast. And that project will be very focused on supplying Europe as well. At the moment, the world's three big LNG exporters, Qatar, United States, and Australia, they're all more or less supplying 80 million tons into the globe. Australian output is expected to be pretty flat for their foreseeable future. Qatar's obviously ramping up an extra 50 million tons by 2027. However, the United States is actually growing faster than any of them at all, and United States is expected to outstrip the other suppliers, and a vast proportion of that LNG will be focused on Europe. The slight caveat to that is most of the big next tranche of projects are only taking FID at the moment. So we saw Port Arthur today. We may see Rio Grande LNG. We may see Lake Charles LNG later this year. So for the next couple of years, the supply is quite constrained, with the exception of Golden Pass. So the ExxonMobil Qatari project, which is huge. It's 15.6 million tons on the Gulf Coast, and that's expected to start up next year. So
and on those different geographies you just pointed out, just to close out on, because the Australia, Qatar, and US. In this sort of new age of energy flows, is there any new geographic destination emerging for those three big suppliers, or are they competing everywhere in the world, or are they going to get their own piece of the world?
Well, like you said in the beginning, Sean, US LNG increasingly staying in the Atlantic basin, with the exception of one project that the US supplies on the East Coast and Gulf Coasts. So yes, we typically expect that to generally stay in the Atlantic basin for the most part. And for the most part, again, we would expect the Australian supply to stay in Asia. That is typically been the case for Australia. You do get the odd cargo showing up in Europe, particularly a year ago with the energy crisis. And then, like you say, the Qataris kind of balancing the two basins out. You probably saw the large long-term 27-year deal the Qatari signed with China towards the end of last year. But at the same time, they're happy to supply certainly short-term volumes into Europe as well. So I guess the Qatari volumes will often depend on who signs those long-term, typically premium priced contracts.
Okay, well, we're going to have to wrap it up there. We're finishing our half hour together with the survey telling us green light to keep going, neither ambiguity, sort of tipping. We'll post that on social to get more people's views on that. We've got Brent trading a little bit down this morning, around $73 on Brent, with WTI still below 70, and we'll see where that goes. A big day coming up with the Fed, with the meetings in Moscow, and also where is your next bank crisis? It does appear there's another bank in the US under stress, but again, the money is bailing it out. And as the week goes on, it seems that the global crisis goes in search of the weakest link. Where is the next weakest link in this banking crisis? It seems Credit Suisse was, now it's somewhere else. And we'll have to keep an eye on that. I think the Fed, I would concur with Carol. I think they go another 25 basis points with inflation rates still coming in at 6%. They really have no choice if they're serious about managing price. So we'll leave it there. Thank you so much, Carol. I didn't even ask you where you are in the world this morning, so I'll say
London. I'm supposed to be in Lausanne. I'm going later.
Okay, London. Paul, I think, also in London, which means both of you have got up very early, so we're grateful for that. Mark Howson is sitting comfortably in his afternoon in Singapore and wondering when he's leaving the office. So thank you, guys. Have a great day. All the best.
Thank you. Bye-bye.
Sure, thanks all.
Thanks a lot.